Gold just printed a fresh high, and the loudest part of this move is in T, the price. It S what the market had to do underneath to make that price possible. Because while everyone stares at the headline candle and blames safe haven, the real story is hiding in the plumbing. Spreads, hedging pressure, and a calendar window that can turn a normal rally into a forced one. And if you catch the hidden detail early, you stop getting whiplashed by the noise, and you start seeing what the next week is actually setting up. But that's not the part that matters. The part that matters is what breaks if one level fails, and what accelerates if it holds. You woke up to gold pushing into new air again, and the dollar sagging like it didn't even want to argue. The vibe is deceptively simple. Weaker greenback, stronger metal, story over. But that's the surface story. The market doesn't move like a textbook when it's under stress, and right now the stress is showing up in the way gold is being priced across time, not just the number on your screen. Because if this was merely a headline spike, you'd see a very different signature in the curve, in the positioning response, and in how dealers are forced to hedge. And that's where the real pressure starts. Here's the first trap. The mainstream explanation will call it risk-off, geopolitics, uncertainty, and they'll sprinkle in, the dollar is down. Those are ingredients, sure, but ingredients aren't the recipe. The recipe is market structure. The recipe is who is forced to buy, when, and at what liquidity conditions. And the difference between a move that fades and a move that becomes a new regime often shows up in the boring stuff people skip. The term structure, the option chain, the way spreads behave when the front end gets bid. Because the market can lie with price for a day. It can't lie with the spreads for long. And the next detail is what flips the whole setup. So let's talk about the hidden detail in plain language. Gold isn't one price. Gold is a strip of prices. Now, next month, 3 months out, 6 months out, a year out. Those prices are linked, but they're not identical, and the gap between them is where you can read stress. In a calm world, the forward months usually trade a bit higher than spot because time costs money. Storage, financing, the opportunity cost of holding metal instead of cash. That's the default gravity. But when the market starts valuing immediate metal more aggressively than future metal, or when the curve flattens in a way that screams urgency, that's not sentiment. That's mechanics. That was the market whispering that the next unit of metal matters more than the unit delivered later, and it changes behavior fast. But that's not the part that matters. The part that matters is what that curve forces participants to do next, because spreads don't exist in a vacuum. If the front of the curve gets relatively expensive arbitrage desks, hedgers, and anyone who lives on small edges starts doing what they always do. They try to lock in the mispricing by buying one point on the curve and selling another. That's how price discovery spreads out across time. And when enough people do that, it pulls the whole complex. It is like tugging a bedsheet. You don't have to grab every corner for the whole thing to move. One stressed corner, enough leverage, and the sheet shifts. That's why you can't just look at gold is up. Oh, you have to ask, is the structure telling me this move is being sustained by urgent demand, tight availability, or forced hedging? Because if it is, you're not watching a normal rally. You're watching a machine. Now layer 2, the dollar. Everybody loves the one-liner. Gold is inversely correlated with the dollar. Fine, but what matters is why the dollar is under pressure. Is it soft because growth is rolling over? Is it soft because rate expectations are shifting? Or is it soft because the market is being asked in real time to reprice trust in institutions, policy credibility, and the framework that holds the entire bond market together? Because those are not the same thing. And right now, a lot of the dollar pressure reads like credibility premium getting repriced, not just rates might go down. And when that's the driver, gold doesn't tiptoe. Gold re-anchors. Because if the framework feels shakier, the asset that sits outside that framework gets repriced higher, even if the world isn't tea on fire. And that's where the real pressure starts. There's also a psychological trick happening in broad daylight. People want to believe they missed it. People want to believe it's too late. People want to believe the next headline will explain it. And the market uses that discomfort against them. It whips you around until you stop thinking in mechanisms and start thinking in emotions. That's exactly when you get chopped. So we're not doing that today. We're doing the grown-up version. What's the mechanism? What's the proof stack? And what do we watch next week that confirms or invalidates the setup? Because if one level breaks, the math changes. Let's build the proof stack. Not one argument. Not one chart. A stack. Layer 1 is the curve and the spreads because that's the market's internal heartbeat. When the near months don't behave normally relative to the later months, it tells you there's urgency or stress somewhere in the chain. Maybe it's financing conditions. Maybe it's the demand to secure metal now. Maybe it's the way hedgers are rolling exposure. It doesn't matter which narrative you prefer. The curve is still doing its job. It's signaling the value of immediacy. And that signal tends to show up before the crowd agrees on the story. But that's not the part that matters. The next layer is who gets forced to respond when price is already moving. Layer 2 is options. And I know, people hear options and their eyes glaze over. Don't let it. This is one of the cleanest explanations for why moves get weird around certain weeks. Here's the simplest version. Options create exposures for dealers. Dealers don't want directional risk, so they hedge. When the market is rising and there's a lot of call exposure near the money, dealers often have to buy the underlying as price rises to stay hedged. That's delta hedging. Now add gamma, which is basically the sensitivity of that hedge. In high gamma zones, small price moves require big hedge adjustments. So a rally can feed itself. Price rises, hedges require buying. Buying pushes price. More hedging, more buying. That's not conspiracy. That's a mechanical loop. And when you're near a big expiry window, that loop can tighten like a ratchet. The next detail is what flips the whole setup. If the market pushes into a strike cluster where dealers are short gamma, the move can accelerate in a way that feels like the market found a new gear. And we're sitting in a calendar where this matters. Late January is not just another week. It's a thin liquidity stretch for many desks. It's a positioning window into month end. And it's also sitting right in the orbit of an FOMC decision. That combination is a classic accelerant. You get people trying to rebalance into month end. You get options exposure decaying into expiry. You get macro funds trying to front run a policy tone shift. And you get liquidity that can suddenly thin out at the worst moment. That's how you get gaps. That's how you get air pockets. That's how you get those candles that make normal people do irrational things. But that's not the part that matters. The part that matters is whether the move is being driven by voluntary enthusiasm or involuntary hedging. Layer 3 is institutional flow behavior. And when big wrappers and allocators start absorbing exposure after price is already extended, it tells you something about the underlying demand for insurance. It can also tell you something about crowdedness risk. Both can be true. A surge in institutional appetite can stabilize a trend, but it can also create the kind of everyone gets in at once condition that makes pullbacks violent. This is why you don't marry a narrative. You track the behavior. You ask, are big flows following price or leading it? Are they accumulating on dips or chasing highs? Are they showing up in a way that suggests strategic allocation or a scramble for exposure because the move got away from them? Because if it's a scramble, the unwind can be sharp. And that's where the real pressure starts. Layer 4 is the slow anchor, official sector behavior. Central banks don't trade like you. They don't care about your RSI. They don't care if the market is overbought. They care about reserves, settlement trust, and portfolio insulation. When that bid is present, it creates a floor under the market that shows up over time, not in a one-day spike. It doesn't mean price can't dump. It means there's a buyer who views pullbacks differently than a levered speculator does. And if you were trying to understand why gold can keep grinding higher even when the crowd says it can T, you have to respect that structural bid exists. You don't need to worship it. You just need to know it's there. Because the next detail is what flips the whole setup. Structural bids make dips opportunities for some, but they also make rallies more dangerous for late chasers because they assume it ends free money. It isn't. Layer 5 is the paper versus physical tension, and we're going to talk about it like adults. You do not need a cartoon villain. You do not need to claim anyone is rigging anything. All you need is incentives, leverage, and different definitions of availability. Paper exposure can be huge, liquid, and fast. Physical availability is real, slower, constrained by logistics, refining, and the specifics of deliverable categories. When those two worlds drift out of sync, when the market is desperate for immediacy, but most of the supply chain is built around lead times, you see stress. Often you see it in premiums, in the urgency of the front end, in the way spreads behave, and the way rolling costs shift. That's not a Twitter conspiracy. That's a supply chain reality, meeting a financial market that can lever up exposure instantly. And that's where the real pressure starts. Now, before we go further, here as the credibility checkpoint. Gold can whip around violently even if the bigger thesis is correct. In fact, the better the thesis, the more violent the shakeouts can be, because the market's job is to transfer the position from weak hands to strong hands at the worst possible emotional moment. That's why you need two lenses, trend signal versus noise. Trend signal is structure. Sustained closes above key levels, spreads that confirm, a dollar that stays pressured for the right reasons, and flow that doesn't vanish the first time price blinks. Noise is the intraday chaos, the headline spikes, the we're doomed and we're saved in the same week. If you confuse noise for signal, you'll get emotionally farmed. And that's not the part that matters. The next detail is how the calendar is about to weaponize that volatility. Because weeks like this create what I call compression stress. You have exposures that must be rolled, hedges that must be adjusted, and macro catalysts that force repricing. Options decay doesn't care about your feelings. Month end doesn't care about your thesis. Funds get measured on calendar points. Risk teams force reductions at certain thresholds. When the market is moving, those constraints become active. And once they become active, you see what people are really holding. You see who is overlevered. You see who has to puke. You see who has to chase. And gold is one of the purest mirrors of that behavior because it sits at the crossroads of macro, currency trust, and risk hedging. Let's translate that into the conflict you're watching. On one side, you have the forces that want stability, institutions that benefit from a narrative of control, from predictable rates, from contained inflation expectations, from a dollar that doesn't signal stress. On the other side, you have a market that's increasingly pricing uncertainty around the framework itself, policy credibility, political interference narratives, debt math, and the invisible tax of currency debasement. Gold doesn't need a dramatic apocalypse. It only needs the marginal buyer to decide, I want insurance. Asna. And when enough marginal buyers decide that in the same window, the move stops being emotional and starts being math. This move isn't emotion, it's math. But that's not the part that matters. The part that matters is what the math forces next. So what does it force? It forces hedgers to adjust. It forces dealers to buy or sell into the move depending on their gamma exposure. It forces macro funds to reconsider how much dollar exposure they want unhedged. It forces portfolio managers who ignored gold for years to answer an uncomfortable question. Why do I have no insurance when the market is repricing trust? And that's how the move can keep grinding even while people keep calling tops. Because the buyers are not all the same. Some are tactical, some are structural, some are forced. And forced buying is the most dangerous kind, for shorts. Now let's talk about shorts without making it melodramatic. Shorting gold is not inherently evil. It's a trade. It's a hedge. It's a positioning decision. But short positions are fragile when price pushes into new highs because new highs remove the easy, it will revert comfort. They also interact with margin. If price rises fast, margin requirements rise, and at some point the short has to either post more collateral or reduce exposure. That reduction is buying. That's a covering loop. Combine that with options-driven hedging and thin liquidity, and you can get a squeeze that looks like it came out of nowhere. It didn't. It came out of risk management. And that's where the real pressure starts. Okay, so where are we right now in the map? We're in the zone where gold has been printing fresh highs in the mid-4600s per widely reported quotes, and the psychological effect of new highs is real. But you do not trade psychology alone. You trade levels and behavior. There are 3 levels that matter conceptually here, and you can map them on whatever chart you use. First is the breakout shelf, the prior resistance zone that price pushed through to print these highs. That's your do we hold the breakout line. If price pulls back and holds that shelf on a closing basis, it's a controlled retest, and controlled retests are how trends stay alive. Second is the last consolidation floor beneath that shelf, the zone where the market repeatedly found buyers before it launched. If price breaks below that and can't reclaim it, the move is telling you it was driven more by temporary pressure than structural demand. Third is the panic line, the level where the move would be invalidated in a way that changes participant behavior, where hedgers stop being forced buyers and become forced sellers. Because if this one level breaks, the math changes. Notice, I didn't give you fake precision down to the dollar. You don't need it. What you need is the concept of levels tied to behavior. Breakout shelf equals, does the market defend the new regime? Consolidation floor equals, was this built on real accumulation or on air? Panic line equals, does forced buying flip to forced selling? Those are the only 3 lines you need to keep your head straight in volatility. And speaking of volatility, let's talk about how the market will try to manipulate your emotions without ever touching a button. It does it with speed. First, you get a surge that makes you feel stupid for not owning it. Then you get a sudden downdraft that makes you feel smart for not owning it. Then you get a bounce that makes you feel stupid again. That's the loop. It's engineered by the structure of liquidity and by the fact that most humans anchor to their last emotion. The antidote is pre-commitment. Decide your time horizon. Decide your risk size. Decide your invalidation. Decide what you will do if it dips and what you will do if it gaps. Then stick to it. Because the market is going to tempt you to abandon your plan at the exact worst time. And that's where the real pressure starts. Now, let's put the 2 scenario lens on this because it keeps you honest and it keeps you from turning into a permanent bull who can't see risk. Scenario 1 is the controlled pullback and retest. Price cools off, maybe the dollar bounces a little, maybe the market gets a hawkish tone scare and gold pulls back to that breakout shelf. You'll hear people scream, top. You'll see social media flip bearish overnight. The question is simple. Does it hold on closing basis? And do spreads and structure behave calmly? Or do they scream stress in the wrong direction? If it holds, that's a reset. That's the market shaking out late leverage and reloading. Scenario 2 is the continuation squeeze. Price doesn't give you the polite retest. It keeps pushing, maybe because the dollar stays under pressure for credibility reasons, maybe because dealers get pinned into a gamma zone, into expiry, maybe because shorts get their margin calls and thin liquidity. In that scenario, the risk is gap moves. The risk is that you don't get the entry you wanted, and that's where the real pressure starts. So what confirms each scenario in the next week or two? Confirmation isn't vibes, confirmation is behavior. For scenario 1, you want to see pullbacks that slow down as they approach the breakout shelf. You want to see selling that looks like exhaustion, not like panic. You want to see the dollar attempt to bounce but fail to regain true strength. You want to see gold recover quickly from dips, especially late in the session, because closing strength matters. For scenario 2, you want to see gold hold above recent highs. Without giving much back, you want to see sharp intraday ramps that don't fully reverse, and you want to see volatility increase while price continues to grind higher. A signature of forced hedging and positioning stress. But that's not the part that matters. The part that matters is what would weaken or invalidate the thesis so you don't get married to it. What weakens it? A meaningful dollar reversal that is driven by restored policy credibility and a repricing of real yields higher, not a one-day bounce. A curve signature in gold that stops signaling urgency and starts signaling easy carry again, suggesting that tightness or urgency is fading. A failure to hold the breakout shelf on closing basis coupled with heavy, persistent selling, because that would say the move was more air than structure. And the big one, if gold loses its ability to reclaim broken levels quickly, if every bounce gets sold harder and faster, that's the market telling you forced buying has flipped to forced selling. That's a different game. And if you're serious about trust, you always keep that door open, because the market is allowed to prove you wrong. That's the deal. That's why you manage risk. Now let's tie the calendar into the checklist, because this is the why now trigger that people ignore until it hits them. Late January is a collision of optionality decay, month-end behavior, and macro catalyst gravity. That means you should expect sharp moves that don't always make sense intraday. You should expect headline candles that reverse in minutes. You should expect liquidity pockets. That's not a bug. That's the environment. Your job is to watch the three tells that cut through it: the dollar's posture, the curve, spread message, and the way the market behaves into key closes. Because the next detail is what flips the whole setup. If gold can close strong into a policy week while the dollar stays pressured, that's not just a trade. That's a statement. So here's your next week checklist in plain language. First, watch the dollar like a hawk, but don't just watch the number. Watch the narrative driver. Is the dollar down because the market expects easier policy, or because the market is pricing trust erosion? The second driver matters more for gold. Second, watch whether gold's pullbacks are being bought quickly or slowly. Quick buying and strong closes suggest real demand and forced hedging. Slow, heavy selling suggests the move is losing sponsorship. Third, watch the speed of moves around key option-related zones. If you see sudden ramps that feel mechanical and they don't fully reverse, that's often dealer hedging pressure. Fourth, watch your breakout shelf. If the market gives you a retest and holds it, that's the cleanest confirmation of trend integrity you can ask for. If it fails and can't reclaim, that's a warning shot. Fifth, watch the emotional manipulation. If you feel the urge to do something impulsive, that's your signal to pause, because the market is doing its job on your brain. And yes, we are going to talk about the uncomfortable truth. A lot of people will get shaken out of a correct thesis. They'll buy the peak of a ramp because they can't stand missing it. Then they'll sell the low of a pullback because they can't stand being wrong. Then they'll watch it rip again and swear the market is rigged. It's not rigged against them personally. It's just built to exploit emotional, leveraged, short horizon behavior. If you're not leveraged and you have a plan, you're already playing a different game. That's the psychology shield. It's not motivational, it's practical. It's how you survive. Now let's bring it back to the hidden detail, because this is the metric that keeps you honest when the headlines get loud. Watch the curve and the spread behavior. Watch how the near months behave relative to the out months. Watch whether the market is paying up for immediacy. Watch whether the curve flattens in a way that signals urgency. And watch whether that urgency persists after big headline days. If it does, it tells you the move is not just sentiment. It tells you the market is pricing stress, tightness, or forced behavior. And that's where the real pressure starts. So what do you do with all of this, practically, as a retail investor or a macro watcher who doesn't want to get played? You don't need to day trade it. You need to map your levels, pick your scenario, and watch your confirms. If your base case is controlled retest, you wait for the breakout shelf, and you watch whether it holds on closing basis. If your base case is squeeze continuation, you respect gap risk and you don't chase with size you can't emotionally handle. If you can't handle a 3 to 5% swing without panicking, you size down until you can. That's risk management. That's how you stay in the game long enough to benefit from the big move. Because the big move doesn't pay you if you rage quit on the first shakeout. And here's the part nobody likes to hear. Even if you're right, it might still hurt. The market can do violent pullbacks inside a larger uptrend. It can do fake breakdowns. It can do flush and reverse days that make you question everything. That doesn't mean the thesis is dead. It means volatility is being used as a weapon. Against late leverage, against weak conviction, against impatient capital. If you're watching the correct metrics, structure, spreads, closes, and the dollar driver, you can tell the difference between a shakeout and a trend break. But that's not the part that matters. The part that matters is you having the emotional discipline to act on that difference. Let's close with something concrete you can carry into the next 2 weeks. 1, the dollar's pressure is not just a currency story, it's a trust story, and gold is the trust barometer. 2, new highs change the behavior of shorts, hedgers, and allocators, so the move can become self-reinforcing through margin and hedging loops. 3, the calendar is a catalyst. Expiry dynamics, month-end behavior, and policy gravity can create forced flows that exaggerate moves. 4, the hidden detail is the curve and spread message. It tells you whether the market is paying for immediacy, and that's a signature of structural pressure, not just sentiment. 5, your job is not to predict the exact tick. Your job is to watch the confirms and protect yourself from the emotional manipulation. If you're the kind of person who wants the truth over the vibe, who would rather understand the machine than argue about the headline, you're already in the right crowd. Stay with the process, watch the structure, let the market prove its hand before you bet yours. And remember, the market can't keep everything hidden forever, because the spreads always confess.